STAG Industrial Stock, ticker symbol STAG. This stock is down 5.85% year to date, underperforming the overall market. And on the 13th of February, STAG presented earnings with a beat on FFO and revenue. Most people love STAG Industrial Stock because of the monthly dividends, and I understand why with dividend yield at almost 4%. But the growth numbers aren't correct here. And I think this is a problem on the side of seeking alpha. And here we see the total returns in the past 5 years including dividends. STAG returned 65%, while the S&P 500 is sitting at almost 100%. A significant difference if you ask me. And with the stock coming down lately and the earnings just released, it is the perfect time to do an analysis. And I'm very excited to see what you guys think about this stock, so please let me know your thoughts in the comments. My name is Thomas and this is Thomas Invest. I'm an investor looking for great stocks at great prices. So what does STAG do? STAG Industrial is a real estate investment trust that is involved in the acquisition and operation of both single and multi-tenant properties. Although the majority of the portfolio is single-tenant industrial properties throughout the United States. And here we see some important details about STAG Industrial. In total, their portfolio consists 112 million square feet with 569 buildings in 41 states. The portfolio's occupancy rate is at 98%, which is a great number. However, the WALT, or weighted average lease term, is at only 4.5 years, which is a bit on the low side if you ask me. The thing that I do like here is that net debt to EBITDA is sitting at 4.9. This number looks really good to me. And STAG Industrial has B credit ratings, and I prefer A credit ratings to be honest. It's not a big problem, but you want to keep your eye on this one. Revenue is reported at 183 million versus 170 million in 2022. To me, this looks pretty decent. Expenses only increased a tiny bit, so this looks good to me as well. Net income increased a significant amount, which is something that I really like of course. Net income per share increased from $0.17 to $0.23, looking really good, especially since the full year numbers aren't that spectacular. And the FFO, one of the most important numbers with REITs, is increasing as well. STAG reported an FFO of $0.59 versus $0.5 in 2022. To me, this looks pretty decent. For the full year of 2022, STAG expects to deliver an FFO per share of $2.36 to $2.40, which is a decent increase from $2.29 reported in 2023. However, I hope they will be on the high side of this range. Acquisition volume is expected to be in a range of 350 to 650 million. And the other numbers here look also pretty good to me. And now that we know more about the company, it is time to check the fundamentals of this stock. But first, if you made it this far into the video, I want to thank you a lot for watching this video. Make sure to subscribe to my channel to receive multiple analyses every week. And also join my Discord channel for free to meet other people within the community and to talk about stocks. It's completely free, so don't miss it out. Let's continue by diving into the fundamentals. STAG Industrial is a 6.77 billion market cap company. PE ratio is not a fair metric to use with REITs, so I'll be using the price to FFO instead. Right now it is sitting at 16.2, indicating they might be fairly valued. Later in this video I will show you my 3 price targets for STAG Industrial stock, so make sure to watch until the end, because price to FFO is only telling a small part of the full story here. Revenue is at 707 million, and in this graph we see that revenue went up in the long run. To me, this looks really good. We see that margins are going up in the long run. This also looks really good to me. EPS is going up in the long run. It is not always steady and consistent, but that is very common for a REIT. Analysis expect that in the coming 2 years EPS will decrease, which is really sad to see. For the revenue it is looking pretty interesting with 7% growth expectations in 2024, but in 2025 they expect to see a decrease in revenue. Return on assets is sitting at 3.5%, which is a low number, even for a REIT. Return on equity is looking pretty decent, and the most important number, return on invested capital, is sitting at 2.7%, which is again a low number. But it is slightly higher versus the 5-year average, so that is the silver lining here. Current ratio is at 1.79, which is a decent number. Nothing really special to mention here. Right now, STAG has 2.6 billion in debt, and I prefer companies that can pay down at least a big chunk of the total debt with the total cash. STAG has 71 million in total cash, so they can't pay down a big chunk of their total debt. This is something that I don't like. So it is very important that free cash flow is growing, since this is used to pay down debt of course, but also to buy back shares, pay dividends and all other things. And here we see that free cash flow is going up in the long run, which is a great thing. Shares outstanding are increasing, which is very common for a REIT, since they increase shares to raise capital. When shares outstanding are decreasing, it increases your ownership in the company, increases the EPS, lowers the PE ratio, and makes it easier to maintain and increase the dividends. And since we're talking about dividends anyways, dividend yield is sitting at almost 4%, which is a great number. Annual payouts at $1.48 and payout ratio is at almost 63%, which is below the average for REITs. And keep in mind, STAG pays a monthly dividend. The growth numbers aren't updated here, which is kinda sad. But in here we see that the dividends paid since 2012 increased at a low rate. However, in the long run this really adds up. And they also recently did an increase in dividends. I'm not sure why Seeking Alpha is not displaying this correctly. In this graph we see the expected dividends in 2024, 2025 and 2026. Of course this is an estimation and can be highly impacted by results, but it gives you a rough indication. It's expected to increase slowly from here. And overall these dividends look really interesting to me, but how about the historical returns? I decided to compare STAG Industrial stock with the overall market, in this case the S&P 500. Next to that I added Americold Realty and First Industrial Realty. On the 5-year chart we see that STAG Industrial underperformed the S&P 500 with a big difference. STAG returned 66%, while the S&P 500 is sitting at 98%. And keep in mind this is including dividends. On the 1-year chart it looks pretty interesting, with the S&P 500 beating all 3 REITs in this list. However, STAG Industrial managed to get almost a 18% return during a time where REITs were having a hard time, due to rates and volatility. On the 6-month chart it is again the S&P 500 that is beating the stocks in this list, with a big difference again. On the 1-month chart it is still the S&P 500 that is beating all stocks in this list. However, both STAG and Cold are getting pretty close. So bottom line, STAG underperformed the S&P 500 long term and short term. But could this be the perfect time to buy STAG Industrial stock? Well, let's check the 3 price targets that I created using the Everything Money software, which is one of the best tools out there. I'm using a low, mid and high assumption to get the 3 price targets, starting off with revenue growth. For the revenue growth I'm filling in 5, 7 and 9% based on historical performance, their own outlook, but also because of the analysis. For the profit margin I'm filling in 26, 27 and for the free cash flow margin I'm putting in 50, 52 and 54. For the PE ratio I'm putting in 20 and for the price of free cash flow I'm putting in 16, 17 and 18. My desired annual return is 12.5% since I can get an easy 10% average annual return with owning an ETF. Right now STAG Industrial stock is around $37. I hit analyze and we only see one green number. And since this is a REIT I'm only focusing on the discounted cash flow value. We have a low price target of $28, we have a mid price target of $35 and we have a high price target of almost $44. And to me the mid to high price target is the most justified here, indicating that this stock is kinda in the middle of this range. Which price target do you think is the most justified here? Let me know in the comments down below. My final conclusion on STAG is that I really love the company. It's one of the smaller REITs positions, but I can't wait to expand my position. Most fundamentals look pretty good and they have been performing quite steady and consistent. From a dividend point of view, things also look really good. They pay a monthly dividend, which is always an interesting thing. But above all, it's really safe and consistent. From a value point of view, I finally get excited again. The stock has increased a decent amount in the past year, which means the valuation was a bit off lately. But with the current numbers, it looks like it is entering the buying zone again. And that is exactly what I will do if the stock keeps falling from here. I do think we can get a better deal than $37, so I will just wait a little longer and then buy more shares. But remember to always do your own research and never fully trust on what I or other YouTubers say about a stock. I'm not a financial advisor and this content is just for entertaining purposes only. I hope you liked this video and I did bring some insights of the company to you. I'd really appreciate a thumbs up and make sure to subscribe to get notified when I'm posting a new video. Thanks for watching and I will see you in my next video.